Your life is multidimensional. It's not defined only by snapshots. You see the big picture. One connected by relationships, career aspirations, and passions. With you at the center of it all. It's why you need an innovative team-based approach to your wealth management, with your insights at the core. It takes more than carbon copy wealth management to address the complexity of your situation. You need a dedicated group of experts, combining best-in-class experience to help you develop a personalized financial plan. And wherever you're headed, a smart investment strategy and the expertise to execute it can help you get there. We're here to help you secure your future without making undue sacrifices today. We help do just that by maximizing your borrowing capabilities, capitalizing on opportunities so you can make the most of tomorrow while you seize today. You're not just filling photo albums, you're also building a legacy. With well over a century helping families do just that, it should all be part of your unique plan. Whether you're concentrating on the day-to-day or living the big picture, we're here to help refine your vision with all the details in focus. Because when your thinking combines with our thinking, that's enriched thinking. Welcome to Scotia Wealth Management.
Managing your company's finances remotely is now more important than ever. With Scotia Online for Business, you can safely and quickly conduct your transactions and save on costs. Accept payments, transfer funds including third-party and wire transfers, view balances and download statements, pay bills and credit cards, make supplier payments, manage payroll, and purchase foreign exchange. Let us handle the way your business does business. Speak with a Scotia representative today. Call 888-429-5087 or email bnsj.businessbanking@scotiabank.com.
Good afternoon, everyone. Welcome to today's event, Navigating Today's Dynamic Market, hosted by Scotia Wealth Management. I want to thank you all for being here this evening. I know you're very busy people, so thank you. We are confident that the information and analysis being shared here will be well worth your while. My sincerest apologies for Roger not being here today. He asked me to express that to you all. Before we begin, I wish to share some quick housekeeping matters. Please set your computers to mute. You may unmute for the question and answer segment. To mitigate against any possible distractions, please place your cell phones on silent and minimize emails and messenger apps. Please know that this presentation is for your benefit and we welcome all interactions. So please share your questions in the group chat at any time or feel free to ask questions at the end of the presentation. Today's speakers are Scott Stollemer, here to provide international context, and our host view from Toronto, as well as Kevin Walters to provide our regional context and commentary. Scott is a senior private portfolio manager and a cross-border wealth specialist with Scotia Wealth Management Investment Advisory Group based in Toronto. Scott specializes in servicing Scotia clients throughout the English Caribbean, including here in Jamaica. His insight is particularly suitable for us as he grew up in Trinidad and Tobago and has serviced our region for over the last 15 years. Kevin is the Senior Manager, Balance and Interest Risk English-speaking region at Scotia Jamaica Limited with 12 years of professional experience, 9 of which is with Scotia Group. He specializes in areas such as investment strategy, asset allocation, risk management, strategic influencing, and security pricing and valuations. Without further ado, I would like to introduce Scott. Scott will ensure that he proceed with his, my apologies. Scott will move forward. Scott, over to you.
Let's try that again. Thank you, Cheryl. I was on mute as well. No, I appreciate that kind of introduction, and a special thank you to everyone who set aside the time to join us today. You know, for me, it's really a pleasure to be here. As Cheryl implied, I grew up in Trinidad and Tobago, but I'm living in Canada now for almost 25 years, and 16 of those years in cross-border wealth management, mainly servicing families throughout the English Caribbean. Jamaica is also particularly important to me as I have family there and friends, and as well as important client relationships and colleagues now well over a decade. So to represent Scotia in sharing these views for the benefit of our Caribbean audience is really something that's quite nice to be a part of. I'm happy that I'm here today. So as you have all gathered, we really have two main goals to achieve today. The first is to provide you with Scotia Capital's head office view on really what's happening now currently in the global markets, as well as where we see things going from here. Second is the goal to pair these international themes with what's happening in Jamaica and really your broader region, to which of course Kevin is going to provide his context and insight on. Both of us understand in this world of information overwhelming everywhere we go, you know, the goal as well is to cut through and just focus on the most important items. So in listening today, you should find that while there are notable headwinds, there are uncertainties in this world, our research is still supporting a net positive looking forward view. And so we're going to provide insight on that over the next 30-40 minutes that we spend together. So all said, we're going to jump in. And this is our first slide. So again, I'm gonna start from an international lens and just give you a quick recap. I know a lot of this is summarizing what we already know, so I'll keep it brief. But basically, we're almost exactly 2 years since most of the global economy was shut down due to COVID-19. And so, of course, we all know as every economy closed, growth dramatically slowed, and then similarly, as all the economies reopened, growth dramatically returned. In the early stages of this dynamic, of course, we saw extreme volatility, extreme uncertainty. That was then followed by historic, and the only word I can think of is a gargantuan lift of policy and stimulus, which ultimately led to quite a rapid recovery. On the volatility side, we saw, it's just fascinating. We saw the fastest minus 30% market drawdown in history, which took place in just 2 weeks in mid to end of March 2020. And that was followed actually by the fastest positive 20 market move in history, which only took 3 days. And I say that because, well, really for those people who think they can time the market, and in my humble opinion, it's just impossible to do that with consistency. And in particular, times like this where volatility is so high, it's just complete sheer luck. There's no, you know, there were days where the market, the first trade of the day was plus 7%. It's just impossible to try to time that. So moving on. Through 2020, of course, no, if you could go back a second, sorry. So through 2020, record stimulus, we ended up with about 35% of global GDP in stimulus, spending programs and various, you know, methods to grow and create economy. We experienced the lowest interest rates on record. For example, the wholesale rate at what the banks lend USD to each other at, it's called LIBOR. It's recently changing, but nonetheless, that wholesale rate bottomed at 0.06, not 0.6, but 0.06, you know, I mean, effectively free. Another one that was interesting for Jamaica, or probably still is, household savings skyrocketed. In the US, the long-term average is about 4% of disposable income is saved, but there were a couple of quarters through COVID where that skyrocketed to 35% of disposable income in savings, which of course it's hundreds of billions of US dollars actually waiting in the system in liquidity. So I mentioned that because we assumed that would help tourist destinations like Jamaica as travel returned to people who are generally starved at that kind of experience and now, effectively have money to spend. So ultimately what happened, 2020 closed with double-digit growth, or most of the markets did. And then on to 2021, that really was an exciting year as the economy, everything was back open. So you had recovery, you had this massive amount of stimulus. And then, of course, the disease itself, COVID, started to take different shapes. So one, you now have the vaccine efforts also is historic. 60% of the world is now vaccinated. Over 5 billion vaccines have been administered. And of course, we've realized that the newer strains are also less lethal than the original strains. So the problem is, at least at this juncture, is believed to be working itself out. All in all, global GDP did roughly 6% last year, 2021, which is compared to a long-term 30-year average of about 2.8. So more than twice what is normal. Again, you're starting from a lower base, and as a percentage change, so it's more pronounced. Unemployment is all recovered, at least in the States and Canada and the developed world. It went from 5% roughly to 13%, now under 5%, just 2 years later. Accordingly, it was quite a good year for the stock market. So US stock market in particular was up about 25%. Albeit bonds actually started to have a tough go in the last quarter, but we'll kind of dig into that a bit more in a little while. So before we dive in more, I want to note that all countries, and not all countries, of course, experience this, not all industries experience this, but what we are showing are official realized numbers based on a net aggregate across the world. Right? If you head on to the next slide, please. We kind of touched on this already. So again, over 5 billion vaccines administered, and the new strains seem less lethal. On to the next slide. So I'll let Kevin kind of take this one in his portion, but yeah, I think we all know the efforts in the Caribbean have been mixed. On to the next. So on to 2022, fresh off of a outstanding 2021, an outstanding half of 2020. 2022 quickly reminded us that volatility is a normal part of investing, as Q1 really brought the first bout of real volatility that we've experienced in basically 2 years. There's 3 main things that sparked this volatility. One is interest rate rises. Second, of course, is the conflict between Russia and Ukraine, which we'll get into. And the third one actually really is linked between the two, and is inflation. So far, I mean, basically what you're looking at, of course, is market performance of fixed income equities and commodities. And so far for 2022, as I mentioned, we've had a tough go. It's the first bad quarter in about 2 years, with the exception, apart from commodities such as oil, which are up about 50% through this, and some key sectors, as you can imagine, defense contractors, energy, metals, companies that participate in those sectors are actually all up double digits. Most global markets actually experience a correction through Q1 2022. On to the next slide. On to the next slide, please. Yeah. So we'll tackle the 3 issues individually. The first is rising interest rates, which is generally born out of an indicator that the economy is doing well, which it has been. Again, we just said that the economy grew at roughly 6% through last year, again, relative to a 30-year average of about 2.8. More specifically, these rising rates are born out of the sentiment that we no longer need emergency rates set at 0. So this was all born out of sensible and sort of positive things in the beginning. Now, looking on the right-hand side, looking 1 year from today, expectations for rates are expected to settle USD around 2.5%, which still is quite generous. Again, it's just not as generous as 0, of course. And then to give you a little context, this was really where interest rates were in 2018. And of course, it's not like when the benchmark rates were 6 and 7 in the early 2000s and late 90s, right? So none of this inherently on its own is really that bad. And again, it was born out of a reality. The economy was doing well. We no longer need these emergency rates. So the next slide tackles inflation, which complicates this a bit more. So remember, inflation or metrics like inflation, GDP, earnings growth, these data points are presented in a year-over-year percentage change format, right? So for example, 2020 had little to no inflation, 21 had roughly 6%. If you kind of average out in the middle, you know, it's not really that much of a concern. And I will say that we had a similar presentation exactly a year ago, and we talked, we mentioned and expected that some inflation was forecasted. It's not really a surprise. And again, if the world goes from zero activity to some activity, percentage change, of course, is going to be pronounced. And then you add in stimulus and all that. So you know, some elevated inflation was generally expected through 2021. And prior to this junction, it's not, you know, we don't expect it to remain at 6% change every single year into perpetuity. That's why you would often hear the word transitory being used by central banks and so on, which was sensible. On to the next issue. So this last key issue is the war between Russia and the Ukraine, and more so what that means for energy and agricultural inflation. And again, that's why I'm saying these three things kind of tied in together. It was born out of something good. Inflation was expected, and now we have something that is murking up the waters. We have a war between two countries that are major players, in particular in commodities of energy and agriculture. And I mean, it's obviously very sad and unfortunate. There's a humanitarian crisis. You know, as with any military conflict, entire cities, communities, families are being destroyed. And unfortunately, there's always some sort of military conflict throughout the world at all times, you know, many of which they don't even get into our news cycle. So why is this different? It's coming back to this reality that Russia and Ukraine are just such large participants in energy and agricultural commodities, which already in a time of elevated inflation, it's just an unwanted distortion. So the global economy knows this. The big economies quickly reacted. They want to make this conflict swift and short, and they've effectively tried to starve Russia's money supply, starve Russia from the global economy with extreme sanctions. And now roughly 70% of the global economy has some sort of sanction against Russia. So the general, general is a feeling that there's an expiry date on how long Russia can carry this on. So to simplify, you know, this issue is what is making things murky and switching this view from transitory inflation to saying, okay, well, it can last a bit more. And you can have these spikes as we've seen in oil shooting up 50%. So on the next slide, what's interesting for us as market investors, for you all, or for us as financial professionals, for you all as market investors, is the reality of how geopolitical volatility has behaved in the past. And, you know, certainly no one knows what tomorrow brings, but history really lends insights to the long-term investor that we can use strategically. So there are two main graphs. We're going to go through the first one here. I mean, even for me, this was quite interesting to realize, you know, the average, or September 11th, for example. I remember when that took place, and the headlines were World War III has begun. And oddly enough, you know, within what is it, 19 days, or the market went down for roughly 10 days, and within 19 days, it was fully recovered and onto growth. So the average sell-off in percentage from a geopolitical event over the last 50 years has only been about 6.5%. And the average down date or the length of that drawdown has only been about 12 days. And the average recovery has been about 4 months. So, you know, is that going to be are we going to be average? Are we going to be an outlier here? I don't know. But ultimately, business tends to find a way. It's almost like water dripping through a wall. It tends to find a way. And historically, these things have really not impacted us that much. On the next slide, we're just assessing, the out of something. What has happened is out of this fallout, most major markets actually ended up in correction. Correction is anything more than 10%. So testing from this point forward, historically, the same thing over the last 30 years, the average 12-month forward market return after 10% drop has been roughly 13%. So the key question, what we tend to look at as financial professionals, is really whether the economy is heading into a recession or not. And currently, which we'll go into, the chance of recession, at least global recession and in the States, is slim. Our models are showing less than 10%. So, and on the flip side, we're still expected to be growing well above that average, a long-term average of 2.8. We're still expected to be growing well above that average. So these things are causing revisions, they're causing lowered forecasts, but ultimately not a full stop and reverse negative growth recession scenario in the present juncture. So it's hard to say how this all plays out, but events like this have historically been opportunities. If you are in this for the long term, for 10, 20, 30 years, any drawdown in general, assuming you're in a well-diversified portfolio, tends to be an opportunity. Well, historically, of course, has been an opportunity. So, all said, these headwinds are really kind of murking things up. And again, we're now having slowing and revisions, but not a full stop and reverse. And this actually just illustrates exactly what I'm saying. 2020 was a negative year. 2021 is rebound. So you got this more pronounced positive year, big returns. And now, say in January, for example, we would have looked at this, I would have told you an expectation of 5.5 GDP, and now it's just shy of 4. So there are these downward revisions, but again, it's not into a recessionary era. One thing that's fascinating with just the reality of math, if you take a look at the Canadian one in particular, so what happens, in 2020 in Canada, the average company made 40% less, at least the average publicly traded company, and then 21 they made 122% more. But it's a reality of understanding percentage change. If you start at $10 and you go down to 5, it's a 50% change. But from 5 recovering back to 10 is 100% change. And so that's why I'm saying you have these huge pronounced numbers in inflation and GDP and corporate earnings. But for us, it's still just to understand, as market investors, over the long term, prices follow earnings. Company makes a lot of money, price tends to go up. A company makes no money, price tends to go down. This is the general market I'm talking about. And that correlation between those two metrics over a 7-year period is actually 95%. And that's the foundation of fundamental analysis. So where I'm going with this, last year you had these massive returns in the market as a result of huge earnings growth. And looking forward, we still have positive earnings growth expected. Despite, this was more pronounced in January. It's come down a little bit, but it's still positive. And to give you a reference point where I said average GDP growth over the long run is about 2.8, average market earnings growth over the long run is about 8 or 9%. So coming in around 11 and 12 is still well above normal. All right, on to the next slide. Another thing that is important for us as equity investors, or for market investors in general, as we are digesting all this news, this complication, the whole commodity story, the inflation story, and so on, valuations are also improving. Because earnings is so high and prices are a function of earnings, the valuation that's taking place is, people might say, oh, the market is highest ever. Yes, but earnings are the highest ever. And so on a valuation standpoint, where prices are a function of earnings, you're actually you're not, or for reference, for example, the US market is priced around 20 times earnings. In the tech bubble, is priced around 30 times earnings. And the long-term number for the last 10 years is about 18.5. So there's not really a value. There are areas where there are valuation concerns, but the broad markets is actually not that many. It's not a particular concern. Again, when you have these earnings that are growing quite nicely. It's not a big concern. Moving on. But fixed income is a bit more of a challenge, and in fact, this quarter is one of the worst quarters for fixed income in a really long time. And there's a separation between, when I talk in fixed income, generally it's large cap, American based or global, large global issuers, whereas locally you will have, it matters more the story of each of the companies, whereas I'm talking more in aggregates, right? So it's important to understand that there are quality companies within every single aggregate that may behave on their own. They will behave on their own fundamentals in general, at least in the long run. So ultimately, bonds, as interest rates rise, in general, bonds tend to have a principal, or tend to go down in principle, because of course, let's say if you have a Scott bond paying 1%, and next week Scott bonds are paying 5%, you show up to the market with a Scott bond with 1% and everyone else is getting 5%, you're going to have to discount your bond. Effectively is what happens. But simplifying, we still see value. Everything's sold off so much right now that we actually see some value in there now, particularly in high quality corporates. Quality matters. High quality corporates, and then long dated sovereigns really still remain a problem, which we've been seeing for about 2 years actually. Again, there are regional contexts that are more appropriate for Kevin. I'm talking in a global sense. On to the next one. Yeah. Okay. So basically through this, as we're still in these kind of murky waters and we don't know really what's going to happen in general, as the world is trying to starve Russia from having resources to continue this for a long time. That is what plays out. We'll kind of normalize. Again, we've cut into some expectation on growth, but we're still in a net growth environment. As well, I mean, the key thing, of course, is that diversification and planning is essential in these kind of environments. Economic growth and inflation is, yeah. So yeah, ultimately, again, diversification is really crucial in periods like this where things become more uncertain. But ultimately, over the long run, if you are well diversified, and if you look at what you hold and see that in general it's quality, at least that's where Scotiabank in general tends to focus, you'll find your way on the other side of this, like every time before. On to the next one. On to the next slide, guys. Sorry. So this just highlights again, despite all this complication, despite COVID, despite a rough quarter, ultimately over the long run, these portfolios tend to do well, or diversified portfolios tend to do well. I mean, of course, in a 1 year period, it was an outlier with all this recovery growth. But even on a 10-year period, a stock market portfolio is still doing about 9%. And then on the flip side, it's important to understand your own risk comforts and realize that, jumping in when things are hot and this and that, and then all of a sudden when there's a drawdown of 7% in your portfolio, getting that anxiety and being, oh my gosh, did I do the wrong thing? Understanding that that's actually normal. And over the last 25 years, that's a fairly normal drawdown, but still a well-diversified portfolio is still done your, 7, 8, 9, 10%. So over time. So I think for me, I'm gonna stop there and pass things on to Kevin, who's gonna bring in some more regional context for you guys.
Thanks, Scott. All right, so we go to the next slide. So picking up from where Scott left off, we're looking at a more regional perspective. And from a regional perspective, GDP performance in 2021 was along the lines of what we expected. We expected developed markets to have a stronger 2021 versus emerging markets. And the reason for that is they had more I guess they had more capacity to leverage more stimulus efforts. Their vaccination campaigns would have been accelerated much faster than us. When we look at the chart here on screen, we're seeing where Jamaica and Dominic, were the standouts in the region in terms of having a stronger 2021 than what was projected for 2022. And across the region in general, we expect a stronger 2022 for Caribbean economies. So moving to the next slide, and Scott would have touched on this a little bit in his presentation. And when we look at vaccination from a global perspective, we're seeing that the world is almost at 60% vaccinated, and when we look at the Caribbean, is much lower, and particularly in Jamaica, which lags the rest of the Caribbean, is about 23%. However, what we've seen in December is that after what was suspected to be the Omicron spike, we didn't see a spike in death numbers and we didn't see a spike in hospitalization. So as such, the move by the Prime Minister in March, which is last month, was not really surprising to withdraw the Disaster Risk Management Act. Now what this means, it posits that there will be a lot of support, particularly for sectors that were heavily impacted by the restrictive measures. So we're looking at entertainment, we're looking at areas that have some exposure to tourism or anything that has some exposure to gathering. So going forward, we look for those sectors to be the sectors that will lead the recovery. And that has been the case over the last couple of months, as we'll show as we go further in the presentation. However, given the fact that we have such a low vaccination rate, we are still exposed to a certain degree of downside risk that we will continue to monitor, and we will continue to monitor to see how things evolve and how that impacts the overall outlook for Jamaica. So moving to the next slide. So we started to see a certain trend, and in general, that's a trend that has taken place globally, but with a lag effect in emerging markets. So what we saw first was that the good producing sectors were the sectors that were really driving the economic growth. And as we started to see some of the measures loosen, we started to see some of the service sectors doing really well. And if you look at the table here, we see that hotel and restaurants over the last 2 quarters would have increased significantly year over year. And that is a function of looser measures and more openness in terms of activity. At this point, when we look at the economy, we believe that the economy will continue on its path of growth in 2022. And this is premised on the relaxation of COVID-19 measures. And again, we spoke about the downsides before. We also think that tourism is expected to get a boost. And this is just, in general, what we've seen in terms of the global posture towards COVID at this point in time. People are more open to travel, and we expect that we'll see some improvement. So we look at the next slide, and from a regional perspective, we're coming from in 2019 about 58 million visitors to the region, significant fall off in 2020, and we understand why that took place. In 2021, it was a bit of a recovery, but still not good enough. Now, when we're looking at 2022, we're expecting a much stronger recovery, and this, in terms of percentage growth, is going to be the strongest recovery that we see in the cycle. However, even though we're expecting some improvement, 2024 is when we expect that, based on forecasts and based on all that we're seeing, that is when we will get back to pre-pandemic levels. So we expect improvement, but we still have some way to go. Now, looking at the next slide in terms of Jamaica, now what we saw is that, we're beginning to see some green shoots in the economy. So in line with what we're seeing for the region, we're beginning to see that for Jamaica. In December, we had the highest number of visitor arrivals that we've seen since the borders were closed. And that was a positive. And again, looser measures, just the general change in posture towards COVID were all things that, contributed positively to that. Now, going forward, we expect this to continue because we believe that, just the appetite for travel will increase. There are some downside risks that we'll speak to going forward, but we are confident that we'll see, a more robust economy, tourism economy going forward, but we'll continue to monitor potential downside risks, particularly emanating from the Russia-Ukraine crisis and what that does to inflation. A lot of that Scott would have touched on in his presentation. Now, moving to the next slide. So when we look at, when we think about foreign exchange earners, we think about two things. We think about remittance and we think about tourism expenditure. Now, as we can see on screen there, in April of 2020, tourism expenditure would have collapsed. And we know the reason for that. It's a beaten path. But what we saw was a significant improvement in remittance flows. And that is attributed to a lot of things that Scott would have touched on, such as supernormal stimulus packages, both from monetary and fiscal authorities. We also saw, a quick rebound in terms of the labor markets in developed markets, and that would have sustained that movement going forward. Now, we always expected, and it's something that we've touched on in our weekly publication, the Scotia Insights, that whenever we started to see visitor arrivals improve, we'll probably start to see a fall off in remittance. And there are several factors that are contributing to the fall off in remittance. I will look at the chart on the right. Even though year over year the growth is still positive, we're seeing some amount of slowing, right? Now, one, a lot of the remittance that was coming in terms of the elevated numbers that we're seeing, were attributed to the fact that people couldn't travel. So once people started to travel, we expect that forex flows will come through informal channels, and then we'll start to see the formal channel numbers kind of dip. Also, the stimulus packages in the developed markets will have waned, and that would also put some downward pressure on what we're seeing. But going forward, we still expect robust remittance flows. We expect to see increased flows from tourism also. So both of those indicators we expect to be a positive for the economy going forward. So now to the elephant in the room, right? And Scott would have touched on it before. When we look at inflation, and there's a lot to digest on this slide, so we'll take it a bit slow here. From a point-to-point perspective, inflation in February was measured at 10.7%, which is the highest it's been on record since about December 2010, right? We've had some double digit in 2013 here or there, but 10.7 is highest going back to 2010. Now, as you can see from the chart here, over the last 9 months and 9 consecutive months, we've seen where inflation was above the central bank's target range of 4 to 6%. Now, as seen in Scott's presentation, also this inflation is a systemic issue. It's an issue that everybody is dealing with on a global scale. Generally, we see a lot of Jamaica's inflation likely being driven by external factors such as higher commodity prices, supply chain disruption, global shortage, and higher oil prices. And again, the conflict in Russia and Ukraine would only serve to make matters worse. Therefore, when we think about inflation, and Scott spoke about the whole idea of transitory, it's expected to be a bit sticky going forward. And overall, this is going to have a significant impact on the local investing environment. And we'll touch on that a little bit more, in terms of the different facets that will flow from inflation and impact the markets. So moving to the next slide. One of the things we're looking at, and it's really an indicator of the strength of the economy also, is the net international reserves. Now, in December, we had a record level of reserves, and what we've seen subsequent to that is a fall off. Now, still robust levels, but we've seen a fall off. And this is largely due to the BOJ's, battle against inflation. And one of the key targets that they set is stability in the exchange rate market to limit the second-round effects of inflation. So whenever BOJ thinks that there is some displacement or disjunction in the market, they'll come in and intervene to kind of normalize the market. Now, I think to keep an eye on, BOJ will use the NIR to defend the currency. However, as commodity prices increases and energy prices increases, what that also reduces what is an important metric in terms of the country's import cover. Now, if that starts to fall, we may see a little bit more reluctance in terms of BOJ getting into the market. So that's something that we stay close to, and that is something that could also impact FX volatility going forward. Moving to the next slide, and just to graphically show, what the activity from BOJ has been in the market since the start of the year. On screen here, we see a cumulative balance of about 520 million in terms of FX intervention that's already taken place. And, to really get a sense of what the effect of that was, when we look at the next slide, we see where, for February and March, we would have seen where the Jamaican dollar would have appreciated versus its US counterpart. So again, stability is a key thing for the BOJ in terms of, its whole inflation mandate. And they will, I guess, at different time periods intervene in the market when they feel like demand and supply imbalances are out of whack. However, we still expect two-way movements. We expect pressure here and there, and that's what we're looking for going forward. So moving to the next slide, when we look at what has happened with liquidity in the market, and when we say liquidity in the market, we measure liquidity by looking at the overnight deposits at the central bank. Now, if you look at the trend that we've been seeing since January 2021, the balances at the central bank has oscillated between, say, our support line of 40 billion and our resistance line of 100 billion. Now, what we've seen over the last couple of months, particularly at the start of the year, we see where liquidity has trended below that, and that is in keeping with one of the key targets of the BOJ. So, in order to manage inflation, what they've been trying to do is restrict J-dollar liquidity, and they've been doing that by increasing rates. And we on the next slide, right, we'll see what the impact is. So the overnight balance, right, has declined significantly, and it's declined significantly in conjunction with the central bank raising its policy rate. And on screen here, you can see where the general trajectory of rates since 2014 has been a downward one, and what we've seen towards the end of the year into the start of this year is a significant uptick. And what that means is that short-term government treasuries or BOJ treasuries have been very attractive for investors. We're talking about the overnight rate being 50 basis points last year to be 450 now. And what that has done, it has given positive impetus to market rates. And in general, what we're seeing is that the market is taking its cues from BOJ. Whenever BOJ raises the policy rate, you can, it's almost with a certain level of certainty that you expect market rates to push higher also. So in terms of where the market is, then short-term yields are much higher than long-term yields. And we've kind of seen that as an inversion of the yield curve, but what it means is that short-term instruments from the BOJ have now become significantly more attractive than they've been for the last couple of years. So, segueing to the equity market, and when we look at the main market, and the overall market, it has a dual personality, right? So we'll start with the main market, and when we look at the main market, from a broad-based perspective, we've seen where the market has underperformed, right? So we look at the left-hand side of the screen here, we see what the calendar year-to-date performance was. And again, it was a tough year overall, so we didn't expect much. And then we saw where, it was basically flat at the start of the year for the entire calendar year in 2021. And in 2022, we're still seeing, some amount of pressure in the main market. Now, moving to the next slide, and we kind of get to dissect, a lot of what is going on in the market. So, next slide. All right. So in general, the main market composition is largely made up of financial stocks, and financial stocks are stocks that typically perform better when the economy is performing better, and in downturns, typically go that way with the economy also. Now, because of that heavy weight from the finance sector, what we've seen is that that has been a drag on the performance of the market to a certain extent. However, we look at the valuations that these stocks had, like in 2019, they were very high, coming off now. So it may be an opportunity going forward, particularly with rates increasing, and we may see some positive impetus on the net interest income side, which bodes well for them. However, we still remain a bit cautious in terms of how far rates go, because higher rates can also impact, the loan performances and, just overall fee income in terms of capital market transactions, etc. But once we start to see the finance sector turn around, we think we'll start to see the main market turn around. Now looking on the other side of the market and moving to the next slide, we look at the junior market. And what we saw with the junior market in general was, it was totally different. So in 2020, everybody, the entire index was down, but the junior market would have performed significantly well since the point of falling off, since that initial bout of volatility. It has been significant, and a lot of what has been driving that, as we see that continue into 2021, and we see a bumper start to the new year for the junior market. And then when we look at moving to the next slide, and we look at just the overall dichotomy of that market, we see where a lot of the major companies on that market are in the manufacturing and retail space. And we know what happened in terms of COVID. These were the companies that were allowed to operate, right through. These were the companies that produced consumer staples, things that we couldn't live without, and it was reflected in their performances. And just to point out the other category here, we saw a significant movement in 2021, and what we see in the other segments is a lot of companies that have exposure to entertainment and tourism. So once those sectors started to reflate, we started to see investors going after those stocks, and they would have performed significantly well. Now, overall, when we think about the junior market, and it's almost a reverse of what we think about in the main market. So manufacturers and retailers are some of the companies that will definitely see some of the major impact from the current inflationary environment. So what we're looking at is, can this performance continue? And the answer to that question is, how well can they actually pass on some of those increased costs? How much of it they can absorb? What type of cost efficiencies they would have developed during the period? And I think that is what will determine where the market goes going forward. Now, just to wrap on the equity market, and this is something that we track at Scotia, and again, it's something that we speak about a lot in our weekly publications. So we look at the amount of companies that report during earnings season, and what percentage of the companies that report actually report earnings that were improved year over year. Now, when we look at this, it's still some positive, even though we're in a very volatile market at this point in time. But almost more than half the companies that are reporting earnings growth year over year, and this number is actually coming down. So when we looked in the pandemic, what we saw was that initially there was a sharp fall off in earnings, but a lot of companies, they would have improved on efficiency and cost management. And what we saw, even though revenues was not growing during the period, we saw where earnings was growing during the period. And what we didn't see was the price recovery. So that was an important thing that we looked at, and we spoke about in general a lot in our weekly publication. So there has been a lot of recovery in the market, even in the main market, and we were not seeing a catalyst in terms of what is going to drive the price move. And I think because people really waiting on the finance sector to move forward. But overall, even though we've been in a very difficult environment over the last couple of years, what we're seeing is that companies are adapting and changing, and they are also reporting stronger earnings going forward. So there is still some value in the market, and we feel like, based on the current economic platform, there is some room for growth once we get on the other side of the current volatile environment. So just to recap on the final slide here, in terms of Caribbean growth, we expect growth to continue. We are cautious, however, of the global headwinds that we're seeing. Inflation is expected to be sticky, and that's going to cause a lot of challenges across the region. Higher rates are going to be the response, particularly for the BOJ. We may see them start to branch off into other methods to curtail liquidity and bring about higher rates. FX volatility is something that we've come to be used to in Jamaica, and we expect that to continue. In terms of capital markets, we expect capital markets to remain very dynamic, because higher interest costs could limit corporate activity. Companies coming to market may consider that this might not be the right time, whilst improve investor sentiment. And we've seen where investor sentiment would have improved at the start of the year, and I think in line with the relaxation of measures may provide positive impetus going forward. And I think that generally ends it for me.
Cheryl, you're on mute.
Okay, I'm so sorry. Thank you. Thank you, Kevin and Scott. It leads one to wonder, in this very uncertain time, how timely is this information? We find it so timely that I want to just ask our clients or our valued clients to write in the chat, ask us the questions, because at this time we open up the floor for question and answers. Gentlemen, I'm going to share a few questions with you, and I'm very sure our clients would love to hear your responses. So the first question that I have is, what investing strategies typically do well in periods of high inflation? And that can go for either one of you.
Okay, well, let me start, Kevin. You could probably take on the regional side as well. I mean, we touched on this a little bit in the presentation. There's sort of obvious areas. So the markets that or the sectors that are experiencing the inflation of course means that the companies that are tied to those commodities, for example, are going to do well. So it's very obvious that energy has had a very strong year. You can imagine all the metals are up. You know, companies like Nucor steel is up 100% looking 12 months back. Gold companies have done well. Anything that is generally elevated is, in the short term at least, tends to get a bump. Now, long term, I think kind of ties into where Kevin was going, and the same thing will happen globally. Markets like Canada, where financials are such a huge component of our economy, granted that rates don't go up so fast that you end up pushing your customers into delinquency on their loans. Ultimately, as rates go up, banks make a percentage of a percentage, and so if that percentage is bigger, of course the earnings goes up, and ultimately it tends to be a good hedge against inflation. But really, the long-term goal is always to have a well-diversified portfolio, have, you know, institutional rules behind it. You know, in our case, we are generally only investing in things that are growing over time. You know, your earnings have to be growing. You have to have quality balance sheets. So, well, actually, to bring it back a step, the quality companies in general will do far better in environments like this. All that stuff of last year, the meme stocks and all these kind of things, you might get lucky, but ultimately the fundamentals below it, you know, all these exciting things that really don't make any money, and they're trading on massive amounts of expected earnings that may or may not show up, tend to have real trouble in times like this. So keep it simple, keep yourself well diversified, keep it in quality, and then ultimately, if you want to be somewhat tactical, as I said, you know, as the areas that are experiencing inflation, or let's say, for example, defense contractors have done quite well, as you can imagine. But have a core of well-diversified quality exposures first, and then you can tack on these small regional sectoral satellites, as we call them. On to Kevin.
Thank you, Scott. Kevin, your feedback?
Yes, so I agree with everything that Scott would have pointed out. We generally take a long-term view, so we always look at fundamentals. So even, you know, companies that will benefit from this inflation boom, you kind of look at what their past record is in terms of, you know, capitalizing on those periods of higher revenues, and how well can they, you know, use that to create sustainable performances going forward. And, you know, that's generally what we look for. We look for quality. We look for companies that have a reputation of doing well. But again, you know, Scott touched on having a well-diversified portfolio. In his presentation, he spoke about how, you know, having that type of portfolio in times of high volatility, you may be able to take some opportunities. Now, typically when you have higher inflation, what you have is the central bank increasing rates at the shorter end. So at the shorter end of the curve, you may be able to get some yield pickup. So you may be able to roll in shorter term securities that continue to roll higher, right? And what that may do is kind of offset some of the losses in your long-term securities from a mark-to-market perspective. So there are several things you can look at, but overall, the core of your portfolio must be something that is fundamentally driven in strong companies, and where available, you can actually look to take some yield pickup on the shorter end of the curve to offset some of the impacts that you might see from raising rates on the longer end of the curve.
Okay, thank you, gentlemen. I have a question from the chat. How likely is a recession in North America within the next 12 months, and why is it or why is not? So how likely do we anticipate that there will be a recession in North America? Will it be in the next 12 months? If yes, please provide a response. If not, please provide one.
Okay, so I mean that was core to the message, is that things are slowing, but not slowing so much. Okay, so we're coming off this hot 2021, again 6-7% GDP growth to a normal number of 2.8, right? And it's percentage change, so it will taper off. It will come back to normal. At the beginning of the year, the expectation was 5.5, another very strong GDP growth year, i.e., chance of recession very, very low. Now you have rates going up, you have all these inflation issues and so on. It is cutting into growth, but not so much that, the car is not going to stop and into reverse here. The chance of recession at this junction, according to our models, is less than 10%. We still anticipate growth this year, and growth that is larger, significantly larger than the 30-year norm. So if we expect to come in around 4% globally, the long-term number is about 2.8. So the chance of recession at this juncture in North America is still it's slim. I hope that helps.
Thank you, Scott. We have another question from our customers. Throughout your career, what is the most important wealth management lesson that you think a Jamaican business families can benefit from? And Kevin, I'm going to call you for that one.
All right, great. So I think overall, one of the things that we look at from Jamaican investors is to have a diversified portfolio, right? We will see volatility over time, and it always impacts your portfolio in the short term. But we look at the long run. For instance, we look at equity, you look at the equity market over the last, say, 15 or so years, we have seen significant gains. Even when we look at the performance of the main market, which has underperformed for the best part of the last 2.5 years, when we look at the last 10 years before that, there's significant performances. So I think one of the best things to do is to have a well-diversified portfolio, in the sense that you can withstand volatility, you can also take opportunities that present itself, and that's how I see it.
Okay, thank you, Kevin. We
Cheryl,
have another question.
Cheryl, I actually I really like that question, actually, and I mean, the first thought is how much time do we have? I think I could talk on that for hours, but I really think one of the most important lessons that I've had, and I've found in my 15-16 years in the Caribbean, I've really found some families are good at it and some are not, and in general, actually, Jamaica, I assume because of the historical ties to Cayman, actually are a bit better than the Southern Caribbean, where I'm from. But it's this realization, depending on the profile, of course. But firstly, is understanding that wealth management is treating your net worth as a business, right? And understanding, to add an image, is understanding that every dollar in your net worth is now an employee, and you have to think of what that employee is doing, if it's working well, if it's working for the government, if it's sitting on the corner doing nothing, this kind of idea. But on top of that, when families get into a position where their wealth is intergenerational in nature, meaning the creating generation is going to leave more than the wealth will outlast them, essentially. One of the things I've realized is that the most common pitfall in wealth is that people, no matter culture, what language you speak, what industry you're from, your religion, your race, it doesn't matter. Historically, 90% of wealth dissipates after generation 3, as the most common rags to riches, back to rags story throughout history. And there are famous billionaire examples, Vanderbilt, for example, where by generation 4, well, Vanderbilt died the wealthiest man in the world in 1885 or what have you. So let's just say Bezos, 200 billions in 1885 dollars equivalent. And the story goes that by generation 4, there was a family reunion, there wasn't a millionaire left in the room. And then you have examples like the Rothschild or Rothschild in particular, which is on 300 years, still billionaires. And of course, that comes back to this idea of wealth is a business. That wasn't by fluke. That was by design. That was by considerable effort and energy. And to me, the key lesson, if the biggest pitfall in wealth is if you care for that, some people say, well, I created what I created, my descendants is up to them. But if you care about carrying it on, you have to think in 100 years. If you have kids at 30 and your kids have kids at 30, that 3 generations is 100 years long. And then you have to teach your kids and then think of in 100-year time horizons and so on and so on and so on. And to me, that is the biggest lesson that I've realized in planning, no matter who, again, in general, there are families that do this well, but in general, that's something that I realize people could do a lot better or should actually change their mindset to think on.
Okay, thank you. Thank you, Scott. We have another question from the chat. Is there any expectation of a reshaping of the world economy over the next 5 years in response to Russia and friend that would have implications for medium to long term? And I'm thinking medium to long term viability of economies, investments, etc. generally. So let me read the question again. Is there any expectation of a reshaping of the world economy over the next 5 years in response to Russia and friend that would have implications for medium to long term? So will there be long-term implications based on what is happening with Russia?
I'm not sure I fully understand the question, but in general terms, right now, the world is trying, as I said, is trying to starve Russia's access to capital and basically, not allow them to finance this, to give it an expiry date, right? That is the effort. Russia
but can I just interject? I think maybe the major point is if there is expectation that there will be reshaping of the entire world economy over the next 5 years based on what is happening.
So, let me try and jump in, right? So I think this is a topical question in terms of a lot of discussions have been going around based on what we're seeing. So when we look at COVID, one of the issues that we saw was that the world is very interconnected, right? And what we've seen with Russia and Europe is that Europe is heavily dependent on Russia for energy. So even though, they're leveraging sanctions, etc., weaning themselves off Russian energy is something that, will take place over time. And that will also lead to some structural changes in how they go about energy, etc. It'll also have significant implications for the energy market going forward. In terms of what Russia is trying to do, Russia is also trying to, create links outside of the US in the form of having people pay for Russian energy in rubles, etc. To a certain extent, there have been a lot of chatter in terms of whether or not the US dollar will be the global currency going forward, etc., based on the fact that Russia and China are leveraging relationships, etc. So, at this point, it's hard to say, but there will be some structural changes coming out of the Russian invasion of Ukraine. And I think energy is the first thing that we're going to see, where Germany and some of the other European countries that rely heavily on Russia will try to wean themselves of that energy. Some states that had demilitarized may start to, look at investing in that area again. So I think that is where, for the most part, we're seeing some of the most obvious changes. I think 5 years, in this timeline is very dynamic. It's hard to say what will happen in 5 years, but in terms of some of the geopolitical outcomes, I think energy is one of them in terms of, trade linkages, etc., and how the world moves forward. I think we'll see some changes coming out of this crisis.
Okay, thank you, Kevin, and I trust we're able to answer that question. We have one more question here What are your thoughts on Bitcoin, cryptocurrency, and blockchain?
Kevin, you want me to start there? So yeah, again, I'm thinking how much time we got.
We have 5 minutes, Scott.
No. I'll keep it brief.
Yeah.
I think, I mean, for me, there's almost being in cross-border banking, being surrounded by regulations that dictates our life. Maybe my brain is carried to that area to say, okay, if Bitcoin by nature is anonymous and by nature all regulation is basically removing transparency, how do these two things meet? But I think before that, I would actually separate blockchain from Bitcoin or from cryptocurrencies and say that blockchain is actually a fascinating tool, and I see that solving a lot of global problems or business problems rather. And I think that's actually quite exciting, and there's a lot of stuff that can get solved there. The issue I have with Bitcoin and crypto, well, firstly, I would say to people, well, you know, a ton of money has been made, right? A huge amount of value has been created. But just realize that this falls into a bucket that is speculative by nature. And when I say that is because the utility, the usefulness of it, it's more become a digital collectible as opposed to a currency. And I don't actually, at least in the current environment, I don't see how it becomes a currency. But the currency is a means of exchange. You can't, obviously, in current dynamic, you can't really trade with Bitcoin. You know, you can't go and buy groceries and gasoline and so on and so on. It's meant to be a store of value, which if you're running a $1 billion business and your assets or revenues are changing by nature of this currency, you know, 10, 15, 20% a month, it just, you know, it doesn't work. Store of value in terms of asset, but also in terms of liability. If every single person is showing up to cryptocurrency as an investment, they're certainly not going to take out a mortgage in Bitcoins, right? And then the third one, of course, is legal tender, which is just complicated. So in general, I consider this as a digital collectible. And mind you, gold doesn't really have that much utility either, but there's a market for it and people want it. There's a market for Bitcoin and cryptos and people care about it and people are, you know, it's valued for what people are paying. So again, I would just say, think of it, realize, call it for what it is. In this moment, it's speculative. Don't bet your house on it. If you want to play with it or put a small stake or whatever you're comfortable with, that's up to you. But understand the other sides of this thing and realize that there's just a speculative side of it.
Okay. Thank you so much, Scott. If there aren't any more questions, I just wish to thank you, our valued clients, for taking the time out of your busy schedule to engage with us today. Thank you for the questions. And a special thanks to our guests, Scott and Kevin. As always, if you have any questions or thoughts and want to discuss them with us, we're here to guide and assist you. So feel free to reach out to your relationship managers. Wishing you all a wonderful evening. You may connect with us to get a copy of the presentation following this evening's event. Thank you so much. Have a good evening.
Managing your company's finances remotely is now more important than ever. With Scotia Online for Business, you can safely and quickly conduct your transactions and save on costs. Accept payments, transfer funds, including third-party and wire transfers, view balances and download statements, pay bills and credit cards, make supplier payments, manage payroll, and purchase foreign exchange. Let us handle the way your business does business. Speak with a Scotia representative today. Call 888-429-5087 or email bnsj.businessbanking@scotiabank.com.
Your life is multidimensional. It's not defined only by snapshots. You see the big picture. One connected by relationships, career aspirations, and passions. With you at the center of it all. It's why you need an innovative team-based approach to your wealth management, with your insights at the core. It takes more than carbon copy wealth management to address the complexity of your situation. You need a dedicated group of experts, combining best-in-class experience to help you develop a personalized financial plan. And wherever you're headed, a smart investment strategy and the expertise to execute it can help you get there. We're here to help you secure your future without making undue sacrifices today. We help do just that by maximizing your borrowing capabilities, capitalizing on opportunities so you can make the most of tomorrow while you seize today. You're not just filling photo albums, you're also building a legacy. With well over a century helping families do just that, it should all be part of your unique plan. Whether you're concentrating on the day-to-day or living the big picture, we're here to help refine your vision with all the details in focus. Because when your thinking combines with our thinking, that's enriched thinking. Welcome to Scotia Wealth Management.